Welcome to the deep dive. Our overarching mission today is, well, we really want to cut through the absolute deafening noise of the daily financial headlines out there.
Oh, yeah, there's so much noise right now.
There really is. And we want to help you construct a comprehensive, ironclad 2026 Singaporean financial playbook. We are pulling from like a massive stack of sources to build this out for you today.
It's quite the stack, honestly. We've got macroeconomic inflation surveys from Singapore Management University, residential property trends from Newmark, corporate salary guides from Raricom.
Yeah, and we're also looking at digital payment data from World First, some really recent REIT performance reports, and these incredibly crucial policy updates straight from the CPF board.
It is a mountain of data.
Yeah.
But, when you lay it all out side by side, it paints a very stark picture of a financial landscape that is radically transforming right beneath our feet.
Right. Assembling this playbook is essentially like putting together this massive jigsaw puzzle, right? Where the pieces range from everything like, I don't know, AI prompt engineering salaries all the way to HDB concessionary loans.
Exactly. But before we get into the actual mechanics of where you should be putting your money, I think we have to address the psychological state you are likely in right now.
Oh, 100%. Because if you are listening to this on your commute or, while running errands, you are probably feeling a very bizarre paradox.
You are likely reading headlines from major financial institutions stating that the economy is growing, that things are robust, and yet...
And yet a single trip to the local supermarket feels like you are navigating a localized personal financial crisis.
It really does.
I always think it feels like driving a car where the dashboard speedometer says you are cruising perfectly at the speed limit, enjoying a beautifully smooth ride. But the engine beneath the hood is making this terrifying metallic grinding noise.
That makes you grip the steering wheel in a cold sweat.
Yeah. Right. You don't trust the dashboard because you can physically hear the gears grinding.
So let's look at the economic water you are swimming in, because the data from the SMU Syndex survey captures that exact anxiety perfectly.
What did they find?
Well, they surveyed Singaporean consumers about their outlook for the year, and a staggering 88.3% expect inflation to rise over the next 12 months.
Wow. Over 88%.
Yeah, and that is actually up from 83.4% just a few months prior in late 2025. And only a microscopic 5% of the people polled think inflation will actually go down.
88.3% expecting it to rise versus 5% expecting it to fall. I mean, that is an overwhelming consensus of economic dread.
It is dread. But the fascinating part is when you dig into the survey, the reasons they cite for this dread aren't even local. They are entirely external.
Wait, really? Like what?
The anxiety is globally sourced. So 64% of respondents point directly to geopolitical uncertainties.
Okay, so like the ongoing conflicts.
Right? They're watching the situations involving Hamas and Israel, Ukraine and Russia, Iran and Israel. And then another 13.3% cite global supply chain disruptions. And 9% are actively worried about higher trade policy uncertainty, like sudden global tariffs.
Right, because people are looking at the fragility of the global order. They are watching retaliatory closures of vital shipping lanes, like the Strait of Hormuz, on the evening news.
Exactly. And they are projecting those massive global crises directly onto their local cost of living.
Well, I have to throw some cold, hard data at this massive wave of consumer panic because the actual economic data shows a completely different reality playing out on the ground in Singapore.
The dashboard versus the engine.
Exactly. According to Newmark and the Department of Statistics, Singapore's GDP grew a very healthy 5% in 2025.
Which actually surpassed forecasts, primarily because Singapore managed to sidestep the worst of the U.S. sectoral tariffs.
Right, due to a relatively modest 10% tariff exposure compared to other manufacturing hubs. And on top of that, unemployment is sitting at an incredibly low 2.0%.
It's remarkably low.
And the kicker, headline inflation actually dropped to 1.2% in February 2026.
And we should note, the base year consumption baskets were also just updated to 2024 to better reflect current spending habits.
Oh, so that 1.2% figure is highly accurate to how we actually live today.
Exactly.
Right. So if the economy is growing at 5%, almost everyone who wants a job has one, and inflation has cooled to near zero levels, why are you, the listener, sweating when you look at your grocery receipt? Why the dread?
We have to look at how human beings actually perceive prices. You do not feel the consumer price index.
No, definitely not.
You don't wake up and experience an aggregate basket of goods. You feel the pinch of highly visible, highly frequent purchases.
Like the morning coffee.
Yes, exactly. The SMU survey noted that consumers specifically expect inflation to increase for everyday items, like food and transportation. When pump prices rise, or your daily hawker center meal suddenly costs 50 cents more, it registers as a massive, visceral, emotional hit.
Yeah, you feel it immediately.
Right. It doesn't matter to your brain that the cost of your household durables or electronics or clothing went down. You buy a television once every 5 years.
But you buy chicken rice every week.
Exactly.
Yeah.
The frequency bias completely overwrites the macro data in your mind.
You are hyper-fixating on the things you buy every single day. The MRT fare, the petrol, the groceries.
And then you add the news cycle to that frequency bias. You are reacting to a constant barrage of notifications about global trade tariffs and wars.
So you anticipate future supply crunches in oil and natural gas, and you naturally assume it will immediately translate to local hyperinflation.
But what that panic often obscures is the preemptive, highly technical action being taken by local institutions to shield you. Like, let's look at the Monetary Authority of Singapore, or MAS. In April 2026, MAS actually tightened monetary policy slightly by increasing the slope of the Singapore dollar nominal effective exchange rate policy band.
Okay, wait, let's translate that. Because if you don't read central bank policy briefs for fun, what does increasing the slope of the S dollar near actually do to your wallet?
That's a fair question. Unlike the U.S. Federal Reserve, which manages its economy by raising or lowering domestic interest rates, Singapore manages monetary policy primarily through the exchange rate.
Because we import basically everything.
Right, we import almost everything we consume. So by tightening the policy, MAS is essentially allowing the Singapore dollar to appreciate. They're letting it become stronger against a basket of currencies of our major trading partners.
Oh, I see. So a stronger Singapore dollar means that when we buy goods from overseas,
Whether that's food, fuel, electronics,
our money goes further. The imported goods become cheaper in SGD terms.
it is a preemptive strike. They are absorbing and curbing imported cost pressures before they can fully cross our borders and hit the local consumer.
Okay, so the engine grinding noise you are hearing is partly real, like the localized cost of your daily commute or your lunch, but it's also heavily amplified by the doom scrolling of the global news cycle.
Right. Meanwhile, the mechanics at MAS are quietly tuning the car under the hood, manipulating the exchange rate to keep that 1.2% headline inflation print grounded.
So the economy is not facing an immediate threat of stagflation.
No, not at all. It is actively managing to avoid the twin challenges of high inflation and stagnant growth. The reality on the ground is just far more stable than consumer sentiment suggests.
Okay, so if the government is managing the macroeconomy, how are you supposed to manage your microeconomy? If living costs still, feel higher despite the data, how is the job market responding to help you pay for it?
That's the real question.
Let's look at the earning landscape and see how paychecks are actually shifting in 2026. Because the Rear-Cohen salary guide paints a picture of a market that is drastically cooling into what they call a sustainable balance.
The guide forecasts an average overall wage growth of 4.0% to 4.3% in 2026.
Which feels a bit lower than the last few years.
It is, and that specific number is a massive signal. It tells us we are officially exiting the rapid hiring era. During the immediate post-pandemic years, we saw this absolute frenzy of headcount expansion.
Right, companies were hiring just to hoard talent.
Exactly.
Yeah.
Now, we are entering the quality era of hiring.
We need to break down exactly where that money is flowing, though, because the differences between sectors are striking. It is not an even distribution at all.
No, definitely not.
Healthcare and life sciences seems to be the undisputed heavyweight champion right now.
It is the strongest sector by a significant margin. They're looking at roughly 6% salary increments across the board.
Wow, 6%.
And this isn't a temporary spike. It's driven by structural, long-term trends that just cannot be reversed. We have a rapidly aging population requiring more intensive care, a massive post-pandemic surge in inbound medical tourism.
Which really positions Singapore as a regional healthcare hub.
Right. And a sudden acute demand for highly specialized tech-adjacent roles. We aren't just talking about doctors and nurses here.
No, we are talking about health informatics specialists and professionals who can manage AI-based diagnostic systems.
Exactly. If you are in clinical research, biotech, or healthcare data management, your leverage in salary negotiations is immense right now.
Speaking of AI, the tech and IT sector is seeing 4 to 6% bumps. But the sources note a really fascinating shift in the language.
How so?
AI is no longer listed as a nice to have or just some buzzword for the R&D department. It's a core requirement. They're specifically calling out new job titles like prompt specialists and AI engineers.
The integration of AI has officially moved from experimentation to execution. Companies are no longer just hiring tech people to build standalone tech products to sell.
Right.
They're hiring AI specialists to sit inside traditional departments like marketing, HR, logistics, just to automate and optimize internal processes.
So an AI prompt specialist in 2026 is someone who knows exactly how to query enterprise-level large language models to generate usable code or draft legal frameworks or analyze massive data sets in seconds.
It is a massive efficiency multiplier. And companies are paying a real premium for people who can drive that internal efficiency.
Which bleeds directly into finance and sustainability, because the green economy is commanding 3 to 5% raises.
We are seeing high demand for ESG managers, carbon accounting analysts, and tokenization experts.
And this isn't just companies wanting to look environmentally friendly on their corporate brochures anymore, is it?
No, not at all. The driving force here is regulatory compliance. The Green Plan 2030, along with the MAS digital asset and AI assurance frameworks, has created a mandatory legal need for these roles.
So environmental, social, and governance criteria are now hard compliance metrics.
Exactly. They're tied to a company's ability to secure funding or list on an exchange. A carbon accounting analyst isn't just measuring emissions. They're actively protecting the company's bottom line from future carbon taxes.
So these roles now require a hybrid understanding of engineering, finance, and corporate law.
Which is why they pay so well.
Now, there's a statistic from the Ria Cohen Guide that completely stopped me in my tracks. They outline something called the bilingual premium.
Oh, this is fascinating.
There is an 8 to 30% salary premium for Japanese-speaking professionals who can act as liaisons between Japan and ASEAN markets. A 30% premium just for speaking a specific language combination.
It sounds wild, but to understand why the premium is that high, you have to look at Singapore's strategic positioning within global trade.
Okay, lay it out for me.
As global supply chains continue to shift away from single points of failure, massive multinational companies, particularly Japanese conglomerates, are aggressively diversifying their manufacturing and consumer bases across Southeast Asia.
Right, getting out of just one country.
But Japanese corporate culture and language are highly distinct. If a company needs to align its Tokyo headquarters with a new manufacturing facility in Vietnam or a logistics hub in Indonesia, they need a regional base.
And Singapore is that corporate gateway.
Exactly. So the bottleneck isn't capital or technology.
It's literally communication and cultural alignment.
Precisely. If you possess the ability to bridge the profound cultural and linguistic gap between a traditional Japanese boardroom and a fast-moving ASEAN market, you are removing millions of dollars of operational friction.
You become the linchpin for their regional expansion.
That is why they will happily pay a coming percent premium for you. You are a rare, highly lucrative asset that software just cannot easily replicate.
Man, that's incredible. We also have to look at the manufacturing sector, though, because the data here tells a really compelling story about how employer behavior is changing.
Oh, the turnover data.
Yeah. The manufacturing sector experienced a massive 26% turnover rate in 2025. More than a quarter of the entire workforce just walked out the door or changed jobs in a single year.
That level of attrition is financially catastrophic for a company.
I can't even imagine.
The cost of recruiting, onboarding, and training replacements at that scale completely erodes profit margins. And the response from employers in 2026 is super telling.
They realize they can't just out-recruit a 26% attrition rate in a tight labor market where unemployment is only 2%. It's too expensive and far too disruptive.
So they are pivoting hard. The data shows they are prioritizing retention over raw recruitment. They are redesigning internal career paths, vastly improving benefits, and focusing on upskilling the talent they already have.
Which brings us to the core shift in the labor market. We are moving from a sprint to a marathon.
Yes. During the rapid hiring era, capital was cheap, interest rates were low, and companies were buying talent at a premium just to get bodies in seats.
Job hopping every 18 months for a guaranteed 20% pay bump was a norm.
But now, in this quality era, capital is more expensive. Employers are looking for a provable return on investment. They are rewarding career longevity, institutional knowledge, and adaptability.
So if the golden age of serial job hopping is fading, how do you actually maximize your earning potential in a marathon market? I mean, if you can't just jump ship every year, how do you force a massive pay bump internally?
By actively developing specific skill overlaps. It is no longer enough to just be a very good traditional engineer.
Right.
But if you are a mechanical engineer who also takes the initiative to master carbon accounting, or an HR manager who specializes in AI-driven skills assessment and predictive attrition modeling.
Oh, then you have leverage.
Exactly. Employers want interdisciplinary talent that can solve complex problems without requiring the company to hire 3 separate people. If you can be the person who bridges 2 critical domains within your current company, you become virtually indispensable.
You transition from an operational cost to a strategic asset.
Perfectly said.
All right, so let's say you've managed to secure that 4% raise, or you upskilled yourself into a new bracket. The immediate next problem is keeping that money from vaporizing.
Which is harder than it sounds.
Exactly. Let's look at spending, cash flow, and the evolution of the digital wallet. Because knowing how the money is coming in is only half the battle. You need to understand the invisible plumbing of the digital economy that is moving it around.
And the behavioral shifts we are seeing in 2026 are fascinating. According to consumer trend data from Planner B, this year is being defined as the year of intentional spending.
Yeah, the sources note that people are moving away from the inflation-driven, fear-based caution that kind of dominated the last few years.
They are exhausted by constant frugality.
Right. Instead, they're moving toward value-driven choices. We are seeing trends like purchasing small luxuries within clear limits, maintaining zero-regret purchase lists where an item sits for 30 days before being bought, and strictly preset spending caps.
We are also seeing the maturation of Buy Now, Pay Later, or BNPL, services within this framework of intentional spending.
No, this is interesting.
Because in the past, BNPL was often viewed and, quite frankly, often functioned as a highly dangerous spending trap for younger consumers.
Oh, absolutely.
But the industry has been forced to evolve. We are seeing tighter regulations, much clearer fee disclosures, strict credit-based spending limits rather than blanket approvals, and automated repayment reminders.
So consumers are increasingly treating BNPL as a legitimate cash flow tool to spread out the cost of essentials or planned large purchases, rather than just a loophole to impulsively buy things they cannot afford.
Exactly.
But wait, calling Buy Now, Pay Later a cash flow tool sounds like incredible PR for what is still essentially a debt mechanism.
It does.
Even with tighter regulations, human nature is still human nature. Aren't we just handing people a more sophisticated, technologically frictionless way to borrow money and dig themselves into a hole?
Your skepticism is entirely warranted. And it brings us to the most important tension in the modern economy, the concept of friction.
Okay, explain that.
Let's look at the world-first data on payment infrastructure to understand why BNPL and digital wallets are so potent. Singapore is currently at an astonishing 97% point-of-sale cashless adoption rate.
97%. Cash is essentially dead for retail.
It really is.
Yeah.
Digital wallets like GrabPay and DBS Payla now account for 39% of all e-commerce transaction value. A decade ago, that number was just 7%.
Wow.
And if you look at Generation Z, Pay Now is the undisputed infrastructure of choice, preferred by 68% of them for their daily peer-to-peer and retail spending.
So the technological friction of spending money has practically vanished. You do not have to go to an ATM. You do not have to count bills. You do not even have to swipe a physical card.
No, you look at your phone, facial recognition authenticates you, you double-click a side button, and the money is instantly gone.
It's too easy.
Exactly. And this is the core psychological insight. As the technological friction of making a payment drops to absolute zero, the psychological friction must be actively, deliberately increased by the consumer just to prevent them from going broke.
Because the environment no longer protects you. You don't experience the physical pain of handing over a crisp $50 bill and watching it leave your hand.
The pain of paying is entirely muted by this sleek interface.
Right.
Because the pain is muted, consumers have to artificially introduce friction back into their own systems. That is the true driver behind intentional spending.
That is why you are seeing the rise of no-buy days, where people gamify not spending a single cent for 24 hours.
And that is why they use apps to put hard lockouts on their digital wallets once they hit a monthly cap. Intentional spending isn't just a trendy hashtag. It is a necessary psychological defense mechanism.
I guess a payment infrastructure that has been engineered by billions of dollars of tech research to be completely effortless.
Exactly.
The contrast between how effortless it is for a consumer to spend money locally and how difficult it is for a business to move money globally is wild.
It is a massive disconnect.
Because the World First data points out that domestically, pay now is incredible. Instant, zero-fee transfers using just a phone number. But Singapore is a global trading hub, and we process a staggering $47 billion per day in cross-border settlements.
$37 billion a day.
And this is where the illusion of frictionless money shatters. Domestic rails like Pay Now completely fall apart the moment a transaction crosses a border.
Pay Now only supports Singapore dollars within the local banking system.
Right. The moment a Singaporean business needs to pay a manufacturing supplier in China or receive bulk funds from an e-commerce platform in the US or Europe, they hit a massive wall of friction.
They're thrown back into the dark ages of correspondent banking networks. They're dealing with opaque foreign exchange spreads where the bank takes a hidden cut, delayed settlements that take days to clear, and forced currency conversions that happen at the worst possible times.
For a consumer, friction is bad. For a business dealing with tight margins, friction directly destroys working capital.
Which is why businesses in 2026 are being pushed aggressively toward multi-currency platforms to bypass traditional banks.
Like the World Account.
Yes, the World Account, for instance, allows businesses to receive payments in over 20 different currencies, hold those balances indefinitely without forced conversions, and pay suppliers in over 100 currencies.
It essentially tries to bring the speed and visibility of domestic wallets to international B2B trade.
Because when you are dealing with cross-border margins, a payment that arrives 2 days late or converts at a terrible FX rate isn't just an annoyance. It can be the difference between profit and loss for that quarter.
Absolutely. Okay, so we have consumers building psychological walls to stop themselves from spending, and businesses desperately seeking technological bulldozers to remove friction from their global supply chains.
That's a great way to summarize it.
So, assuming you have successfully implemented that psychological friction, you haven't vaporized your paycheck, and you actually have leftover cash. In 2026, what are you supposed to do with it?
Well, the days of passively parking your money in a single high-yield account and forgetting about it are officially over.
Because the macroeconomic signals point to global interest rates softening.
Yes, we are exiting the era of aggressive, risk-free fixed deposit promotions and massive T-bill yields that really defined the last couple of years when central banks were hiking rates.
Right. Planner B highlights that savers are aggressively shifting to what they call blended cash strategies. They aren't relying on one product.
No, they are spreading their short-term, liquid funds across a mix of cash management accounts, T-bills, high-interest savings accounts, and ultra-short-term bond funds.
Managing your cash used to be like planting a single sturdy oak tree in your yard. You put your money in a fixed deposit, you locked it away for 12 months, and you just watched it slowly grow.
But in 2026, managing your cash is much more like managing a highly dynamic conveyor belt. You need different buckets of liquidity, constantly moving and optimizing, based on slight shifts in yields.
And active cash management is no longer an optional optimization just for finance nerds or the ultra-wealthy. It is mandatory for everyday wealth building.
Because if you leave your money static in a basic savings account, inflation even cooled down to 1.2% will still erode its purchasing power faster than the bank's microscopic base rate can replenish it.
The good news is that the tools to manage this conveyor belt have leveled up significantly.
Oh, hugely. Look at robo-advisors. 5 years ago, a robo-advisor was basically a simplified platform for beginners who were too intimidated to buy stocks themselves.
Right. Just answer a few questions and get an ETF.
Exactly. But in 2026, they've evolved into highly sophisticated core investing platforms for everyone.
The deep AI integration is what changes the game here. They don't just ask you for a risk profile and dump you in an ETF anymore. They offer predictive cash flow tools that analyze your spending patterns across your linked bank accounts.
And they offer automated rebalancing that reacts to market conditions in real time.
We are also seeing the rise of hybrid models, right?
Yeah, you get the algorithmic efficiency and low fees of the AI managing the day-to-day trades. But you also have access to human advisory support when you need to make a complex emotional decision. like planning for a mortgage or navigating a major life event.
Because the digital banks are fighting tooth and nail for those deposits, and their apps are reflecting that desperation to keep you within their ecosystem.
Your banking app is no longer just a digital ledger showing your past transactions. It is evolving into an active, central financial hub.
We are seeing digital banks offer account tiers tied directly to your salary crediting, integrated partnerships with retailers, and incredibly smart budgeting insights.
They even use AI alerts to warn you if you are trending toward breaking your intentional spending caps before you actually break them.
But how does someone navigate this without making cash management a full-time job? I mean, if the fixed deposit is dead and you have to manage a conveyor belt of T-bills, robo-advisors, and digital wallets, how do you not go crazy?
The overarching theme for personal finance in 2026 is the transition from vague money goals to ironclad money systems.
Systems, not goals.
Exactly. A goal is a destination. Saying, I want to save $10,000 this year is a goal. It relies entirely on your willpower and discipline every single day to not spend money.
And willpower runs out.
It does. A system is the automated process that guarantees you reach the destination regardless of your willpower.
So you set up salary allocation rules, like the 50-30-20 rule for needs, wants, and savings, that trigger automatically the exact second your paycheck hits your account.
You set up automated recurring investments into your robo-advisor on the first of the month.
You use app-based envelope budgeting to lock your funds away. You build the plumbing once, and then you just let the water flow.
Because relying on raw willpower to save money every month fails. The human brain is not designed for it. Decision fatigue is a real, scientifically proven phenomenon.
Every time you have to decide whether to transfer money to savings or buy something, you are depleting your willpower.
A blended cash strategy managed by automated systems removes the decision-making process entirely. It runs quietly in the background, vastly outperforming discipline.
Well, if we are talking about automated system-level wealth building, we absolutely cannot ignore the ultimate foundation.
The guaranteed floor beneath every single Singaporean's financial house. The Central Provident Fund.
The CPF is going mainstream in a way we haven't seen in previous generations.
It is a remarkable generational shift. 10 years ago, CPF planning was a niche topic reserved almost entirely for pre-retirees in their 50s trying to figure out their payouts.
Yeah, younger people barely thought about it.
But today, young professionals in their 20s and 30s are actively using it as a foundational, aggressive wealth-building tool from the moment they get their first paycheck.
Let's talk about the absolute stability of CPF first, because in a world of softening bank rates, algorithmic trading, and geopolitical anxiety, this is the anchor.
It really is.
The CPF board just announced that for the third quarter of 2026, CPF interest rates remain completely unchanged. The ordinary account stays at 2.5%, and the special, MediSave, and retirement accounts are at a guaranteed 4%.
And crucially, the HDB concessionary housing loan remains pegged at 0.1% above the OA rate, so it stays locked at 2.6%.
The psychological and financial value of that predictability just cannot be overstated.
While the rest of the world is stressing over floating mortgage rates tied to volatile central bank decisions, wondering if their monthly payment is going to suddenly jump by $500, Singaporeans utilizing HDB loans have complete breathing room.
They can plan their cash flow with absolute certainty.
And that 4% floor on the special and retirement accounts is incredibly powerful right now. The pegged rate for those accounts, which is technically based on the 10-year Singapore government securities yield plus 1%, actually fell below 4% recently due to global market shifts.
Right.
But because the government mandates a CPF floor rate, members are completely shielded from those market conditions. They continue to receive the guaranteed 4% regardless of what the bond market does.
Which explains exactly why young people are flocking to it. They look at the math. They are doing early special account top-ups to let compound interest run for 3 decades.
They are maximizing their MediSave top-ups not just for healthcare, but to strip away their taxable income through tax reliefs.
Yeah, I see young people utilizing the VC3AC, the voluntary contributions to the 3 annual CPF accounts. Let's break that down for a second.
Sure.
If you use the VC3AC, you are voluntarily dumping extra cash into your CPF, and it gets distributed across your ordinary, special, and MediSave accounts according to your age cohort's allocation rates. You can't touch that money for decades.
Right.
Is this surge in CPF's popularity among younger millennials and Gen Z a sign that we are actually becoming a more financially conservative generation terrified of stock market risk? Or are we just becoming more mathematically ruthless about extracting risk-free returns?
It is absolutely the latter. It is mathematical ruthlessness.
Really?
When bank fixed deposits are dropping and the stock market feels volatile due to the global trade tensions we discussed earlier,
Yeah.
locking in a guaranteed risk-free 4% return that compounds tax-free over 30 years is not conservative. It's a highly optimal, aggressive strategy.
They deeply understand the time value of money.
Wow. They realize that securing a guaranteed 4% floor frees them up to take much higher asymmetrical risks with their private liquid investments.
And the government is actively incentivizing the system building, particularly for older workers who might not have 30 years for compound interest to do the heavy lifting.
Let's look at the 2026 policy updates. For workers aged 55 to 65, there's a 1.5% contribution rate increase.
And the crucial detail here is the routing of that money. That entire 1.5% increase is channeled directly into their retirement account up to the full retirement sum.
It is not going to the ordinary account to be used for housing. It is a targeted, mandated boost to force retirement adequacy in a worker's final decade of employment.
And to ensure businesses don't just fire older workers to avoid the cost, employers are receiving a CPF transition offset to cushion the business expense of this increase.
But the real magic, the absolute free money aspect of CPF in 2026 is the expansion of the matching grants.
Yes. Let's unpack the Matched Retirement Savings Scheme, or MRSS.
The MRSS is a scheme originally designed to help senior Singaporeans with lower retirement savings build their nest egg. And in 2026, it has been massively structurally expanded.
Okay, tell me the changes.
First, the age cap has been removed entirely.
Yeah.
Second, the matching grant has been increased from $600 a year to $2,000 per year, with a $20,000 lifetime cap.
Wow.
And finally, it has been expanded to include members with disabilities of all ages, not just seniors.
Let me walk through a hypothetical scenario to make sure I understand the absolute power of this math.
Go for it.
Let's say I have a 60-year-old mother who hasn't hit her basic retirement sum. If I, as her child, transfer $2,000 of cash into her retirement account this year, the government just looks at that and matches it with another $2,000 from the state.
Dollar for dollar up to the cap. Yes. Your $2,000 deposit instantly becomes a $4,000 balance in her account.
That is an immediate, guaranteed 100% return on investment the second the transfer clears, before a single drop of the 4% compound interest even applies.
Exactly. You literally cannot find a 100% risk-free return anywhere else on the planet. This fundamentally changes the retirement trajectory for lower-income families.
It alters the math entirely.
And they're piloting a very similar concept for healthcare called the Matched Medisave Scheme, or MMSS.
Oh, how does that work?
It targets citizens aged 55 to 70, matching voluntary cash top-ups to their Medisave account up to $1,000 a year. This is specifically designed to help older citizens cover rising insurance premiums and long-term healthcare costs without draining their liquid cash.
The CPS board has even centralized all of this strategy into a massive digital tool called Plan with CPF.
It's a comprehensive dashboard with a retirement payout planner, a home purchase planner, and a health insurance planner.
They are practically begging citizens to use these systems to optimize their wealth.
Which brings us back to the core theme. Utilizing government matching schemes like MRSS is essentially collecting free money that compounds. It provides a psychological comfort and a mathematical foundation.
If you know your basic retirement needs are entirely funded by guaranteed systems, you don't panic when your robo-advisor portfolio dips 5% due to a global headline.
Precisely.
So we've optimized the liquid cash with blended strategies, we've locked down the CPF safety net, and extracted the matching grants. Now let's talk about the heavy artillery.
The brick and mortar.
Let's look at where the massive generational capital is being deployed, the real estate market.
The residential property market in Singapore is a fascinating study in engineered resilience. Despite all the global headwinds, the inflation fears, and the high interest rate environment globally, 2025 was incredibly robust locally.
The Newmark data is pretty stunning. It shows 10,815 new home sales. That is the highest volume since 2021.
And the secondary market, the resale and subsale of existing private properties, saw over 15,000 transactions.
And the prices are still climbing. landed property prices surged 3.4% just in the fourth quarter of 2025 alone.
While the overall residential price index is forecasted to rise another 1 to 3% in 2026.
This market feels like a medieval fortress. Foreign money is effectively being kept at the gates by the boiling oil of the 60% additional buyer's stamp duty. But inside the walls of the fortress, the local residents are trading furiously with each other, driving the prices up organically.
The boiling oil analogy is highly accurate. The 60% ABSD levied on foreign buyers has successfully, almost entirely suppressed speculative foreign demand.
So the price growth and the transaction volumes we're seeing are not artificial bubbles created by offshore hot money.
No, they are almost entirely organic. They are driven by massive domestic upgrader demand.
Upgraders meaning families selling their public HDB flats to buy private condominiums.
Correct. And that upgrader demand is supported by the foundational economic pillars we discussed earlier. We have strong employment numbers, low unemployment, and steady wage growth.
And more importantly, HDB resale prices have remained incredibly strong.
Right. When a family sells their HDB flat at a premium, they unlock a massive amount of equity. They take that cash, combine it with their strong CPF balances and high salaries, and deploy it straight into the private residential market.
It is a closed-loop system of domestic wealth transfer. Physical property inside the fortress is resilient. But what about paper property?
REITs.
Yeah, what if you want exposure to real estate without taking on $1 million mortgage? Let's look at real estate investment trusts. The Smart Investor Report paints a picture that is truly a tale of active management.
You have winners who are crushing it, and you have losers getting battered by the macro environment.
On the winning side, you have Capital Land Integrated Commercial Trust, or CICT. They grew their gross revenue by 8%, largely fueled by aggressive portfolio transformation, including a massive $3.9 billion acquisition of Paragon to cement their retail dominance.
And Fraser Centerpoint Trust, FCT, saw revenue surge 20.3%, with an unbelievable 99.8% occupancy rate in their suburban retail malls.
And Suntech REIT absolutely shocked investors with a 23.9% jump in their distribution per unit, or DPU.
The retail spaces are really thriving.
99.8% occupancy for FCT is wild. It means almost every single square foot of their malls is generating rent.
Yeah.
But I want to pause here and look at First REIT.
This is an important case study.
Because this is where the popular narrative that REITs are always a safe asset completely falls apart for me. First REIT is a healthcare REIT. They own hospitals and nursing homes.
Right.
In terms of tenant stability, it does not get more defensively recession-proof than healthcare. People always need hospitals. Their assets maintain 100% occupancy. 100%. Every single bed, every single facility was leased. And yet, their distribution per unit, the actual cash paid out to investors, slid 13.8%. They lost money for their investors despite perfect operations. How does that happen?
This highlights the vital, critical difference between owning physical real estate and owning paper real estate. When you own a physical condo in Singapore, your returns are driven purely by local supply, local demand, and local vacancy rates.
The ABSD protects you from foreign volatility. Your asset is anchored to the ground you stand on.
Right. But a REIT is different.
Because it's paper.
When you buy a REIT, you are not just buying a building. You're buying shares in a publicly traded corporate entity that owns real estate. And that corporate entity is vulnerable to intense corporate finance risks.
The cost of debt, leverage ratios.
And crucially for First REIT, severe foreign exchange risk.
Walk me through the mechanics of that foreign exchange risk, because I think it's confusing for a lot of people.
First REIT owns a significant number of healthcare assets in Japan and Indonesia. Therefore, they collect rent from their operators in Japanese yen and Indonesian rupiah.
But First REIT is listed in Singapore, and its investors expect their dividends paid in Singapore dollars.
Oh, wow. I see where this is going.
Remember our discussion about the macroeconomy at the very beginning of this deep dive?
Yeah, the MAS preemptive strike.
We talked about how the Monetary Authority of Singapore proactively strengthened the Singapore dollar, increasing the slope of the S-dollar near to fight off imported inflation and keep your groceries cheap.
Yes.
That exact policy means the Singapore dollar became incredibly strong against currencies like the yen and the rupiah. So First REIT collects their rent in yen. The hospitals pay in full 100% occupancy.
Right.
But when First REIT takes that massive pile of yen and converts it back into the ultra-strong Singapore dollar to pay dividends, the exchange rate completely crushes the value. The yen buys fewer Singapore dollars.
That is mind-blowing. The very policy that Manas used to protect the local consumer at the supermarket is the exact same underlying mechanism that crushed the dividend yield of first REIT investors.
Everything in the financial system is connected. You cannot look at a REIT in isolation.
Which is why First REIT is currently undergoing a massive $471.5 million divestment of its Indonesian assets.
They are actively pivoting to sell off those assets to buy into developed markets with stronger currency pairings.
It proves that in 2026, the idea of passive management in REITs is dead. You cannot just buy a REIT and hold it forever. Active asset management, buying, selling, refinancing debt, and actively hedging currency risks is the only way these trusts survive and deliver value in a volatile global macro environment.
This has been an incredibly dense, fascinating journey through the data. We have to synthesize this and bring it all together.
Definitely.
If there's one overarching, flashing neon sign of a theme for 2026, it is the absolute necessity of transitioning from vague money goals to ironclad money systems.
The financial landscape in 2026 is far too complex, and the technological systems are far too advanced for you to navigate on intuition alone.
Whether you are dealing with the psychological illusions of frequency bias at the supermarket, whether you are actively upskilling yourself to overlap with AI engineering to secure a marathon career, whether you are building a blended cash conveyor belt across robo-advisors, or mathematically extracting the maximum value from MRSS government matching.
Success this year requires being deliberate. It requires being proactive.
You cannot just leave your money in a default state and hope for the best. You have to actively build the plumbing.
Yeah.
But I want to leave you with a final, slightly provocative concept to mull over.
Okay, let's hear it.
We've spent a lot of time today talking about AI tools, robo-advisors optimizing your investments, and the necessity of building psychological friction to fight the fictionless digital wallet.
Right.
But what happens when our spending becomes entirely algorithmic?
Walk me through what you mean by algorithmic spending.
Think about the trajectory of the technology we just discussed. If an AI integrated into your digital bank begins to know your financial systems, your long-term goals, and your behavioral habits better than you do, will we soon see a world where your banking app literally blocks your digital wallet from buying a $7 iced coffee? Not because you don't have the cash in your account, but because the AI mathematically calculated that this specific $7 purchase, factored into your compounding trajectory, will delay your target HDB property upgrade by exactly 4.2 days.
A completely frictionless payment system enforcing the ultimate, uncompromising psychological friction.
Exactly. When the systems get that smart and the algorithms are managing the conveyor belt of your blended cash flawlessly, maximizing every basis point of yield, who is really in control of your money?
You or the system you built to protect yourself from yourself?
It's something to think about the next time you tap your phone to pay. Because right now, you might hear the engine grinding, but soon you might not even be allowed to touch the steering wheel.
If you found this episode helpful, do subscribe to my channel for more smart finance content. I'll see you in the next one soon.